So welcome everyone. Thank you for joining the Investment Banking Overview Prep session. So in this session, we're going to go ahead and overview, what the investment banking interview looks like, what the role looks like, and have some questions fielded from our panelists. And throughout, please feel free to ask your questions via the Pathable chat, as this is a Zoom webinar, so there won't be a chat feature in the Zoom, but please send your questions through Pathable, and we will address those all at the end. We also encourage you to direct them to specific panelists if possible, so we can direct the question flow appropriately. So we'll start off with some panelist introductions. So I can go ahead and start by introducing myself. My name is Chandra Sahu, as I've mentioned. I use the pronouns she, her, hers. I went to the University of Michigan, went to the Ross School of Business, and also am from Michigan, and graduated in 2019. And attended O4U in 2016, 2017, and 2018 for the business conference. Met a recruiter there that really started my journey with Goldman. And so was a sophomore intern in the real estate group at Goldman Sachs, and then moved on to the consumer retail group my junior summer, where I returned full-time and have been for about a year.
I'm Chris Elmore, Vice President at Goldman Sachs. I use he, him, his. I've been with the firm a bit over 12 years, so I almost predate O4U from my recruiting timeline when I was a summer analyst first in 2007, then came back in 2008. I sit within our public sector and infrastructure banking business, and I co-head our transportation and P3 group. So that is predominantly financing for airports, ports, toll roads, mass transit agencies. And I think, let's see, did I miss anything? And I did my undergrad at Stanford.
Hey everyone, my name is Michael Parrish. I'm a vice president in the middle market investment banking group at Wells Fargo. I use the he, him, his pronouns. I graduated from UNC Chapel Hill in 2012. I've been in investment banking as an analyst associate or VP for about 8 years now. And my group is a specialty group. We do all products and all industries. First time I came to O4U was in 2016. So I wasn't out when I started at work. Yeah.
Hi, John Jabroni. I'm a second-year associate at RBC Capital Markets here in New York. I'm a two-time OUBC alum back in 2016, I want to say. Graduated Yale with a history major, and I work in equity capital markets doing specialty kind of non-traditional equity financings and derivative financings. So happy to talk about all that.
Hey guys, this is Madalena. I am Portuguese. I started my career in London with Morgan Stanley 8 years ago. I moved to São Paulo for 4 years. I moved to New York 3 years ago. I sit in the natural resources group here at Morgan Stanley, and lovely to meet you all today.
Hey everyone, my name is Faris Amashe. I'm a third-year associate at Macquarie Capital. I graduated from the Ivy School of Business at Western University in Canada in 2013. I started out my career in private equity and moved over to the investment banking side last year. I focus on infrastructure and energy M&A.
Awesome. Thanks all. So we'll go ahead and move into the general overview of investment banking. So one of the ways I've heard investment banking described is that we provide those who need capital money with those who have it. So whether that's through M&A, companies buying and selling each other, or accessing public markets with equity, IPO, that is the role that we play. We provide corporate finance and advisory services for clients. Generally, banks organize their investment banking groups in two ways, with product groups and industry groups. So product groups will specialize in one or a couple of financial products across many industries. So for example, M&A, equity capital markets, debt capital markets. And so with these groups, you're really drilling and honing in on a particular expertise about a certain product and applying it for a wide variety of clients. Whereas in our industry groups, you would specialize in one industry but cover many financial products. So perhaps you have a client coverage team and whether the client wants to do M&A or IPO or whatever the case may be, you're bringing in the product groups to help support that. And so some examples of industry groups would be technology, media, and telecom, which you may be hearing as TMT, financial institutions, natural resources, consumer retail, etc. The one thing that I'll note on this page is that banks all organize their functions differently and may have different names for similar functions. So as you're going through your recruiting process, it's important to recognize that and try to get an understanding and map out, like at this bank it's called this, at this bank it's called this, and here's what I'm interested in and why. And a particular nuance I would note is that, for example, at Goldman Sachs, our M&A expertise is embedded in our industry groups. So while at another firm you may see that there's really just an M&A group that handles the M&A, we embed all of the products in our industry groups. And so that impacts your experience as an analyst. So as you're thinking about recruiting, would make sure that you know the right questions to ask recruiters and folks to understand their structure and say like, hey, here's how I understand the structure. Let me know if that's correct, yada, yada. So that is that general overview. I will also add a bit of color that I forgot, which was that without being able to see your faces and talk to you all, we don't know what level of background and understanding you have in investment banking. So we will make this session more topical and high level, and we'll try to get through the meat of it in 20 minutes so that we can get to your questions, and feel free to ask more granular questions in that section. So in this session, we're going to cover a few of the really key aspects of an investment banking interview that you will see. The first is why banking. Then we'll cover a couple of different valuation methods that you will use in your time as an investment banking analyst, and so what you will need to know for the interview. And then finally, the industry landscape and trends that will be relevant for your investment banking interview, which hopefully all leads to an offer. So again, here's our agenda. A lot of people see banking and banking interviews as highly technical, and they are, make no mistake, but a lot of the interview process questions are fit-related questions. So folks really want to make sure that you have an understanding of what the role is, what skills are required, and what you bring to that role. So you want to make sure that you craft a coherent story that gets from A to C really easily and is still genuine and is your own story rather than something that's regurgitated from a framework. Then you'll need to know a couple of different kinds of valuation. Valuing companies is really the meat of our work, and so you'll want to understand the way that we do that. And then finally, industry landscape. It'll be important to be able to demonstrate that you're keeping up with industry trends, that you have a lot of curiosity around what's driving certain markets, M&A or IPO or debt or whatever that may be for you. And you want to be able to exemplify that curiosity in your interview. So we'll take a step back first and look at the interview process and timing. For banking, it can be a bit of an accelerated process versus other careers. So you will typically recruit in the late spring or early summer rather than the fall. So if you're recruiting for a junior summer internship, you might do the recruiting your sophomore spring, early summer. So a lot of that for this next year has happened or is in the process. You may start reaching out to folks to network and understand their role in mid-summer, have a lot of conversations to inform your behavioral answers, and then move into your first round and second round as you get further into the summer. The first round is typically going to be in-person or virtual. In this environment, of course, everything is virtual, but this interview will really be more behavior focused, making sure that they understand your background and it seems like you could be a good fit for the particular bank and the groups that you're interested in. The second round in banking is what's called a super day, and so you'd have typically 1 day of interviews, maybe 3 to 4 interviews with 1 to 2 interviewers in that room with you or in the Zoom room who are asking both behavioral and technical questions to evaluate now, okay, we have a feel for who you are as a person, what's your technical background, are you able to exemplify that you have been really curious about these subjects and that you understand the foundation of the work that we do. And then what we'll spend a bit of time on is crafting your story. So the first question you're likely going to get in every interview is, walk me through your resume. this is something you want to spend a good bit of time developing, and it's not going to be, literal bullet by bullet walkthrough, but it should craft a really coherent story of how you ended up in this seat, not just interviewing for banking, but interviewing to be in a banking summer analyst or analyst role at this particular bank, in this particular product group. You really want to make your answers tailored and specific and personal. So getting into crafting that story, when you're preparing yourself to enter these interviews, you can think about prior internship experience you've had, classes, clubs or extracurriculars, or personal interests that have informed your experience and led you to end up in this chair interviewing for this position. And as you're thinking about those experiences, you want to identify the traits that make a strong investment banking analyst, such as responsibility, teamwork, technical analysis, and client service, and figure out how you have exemplified those traits in your previous experience, or begin to shape the experiences that you have to make sure that you're getting those skills and you're able to showcase them. I will note that when I was recruiting, I was not super involved in, competitive investing clubs or a ton of finance classes. And so for me, my story was really about understanding that the role of the analyst requires an ability to manage multiple priorities, to work in teams, and to be really intellectually curious. And so those were the things that I focused on in my story answer. So to our panelists, wondering, how did you answer why banking when you were in the interview process, and perhaps how would you answer it now?
Yeah, so when I went through the banking process, I was a first generation college student. Didn't really know a lot about investment banking. So kind of similar to what Chandra said, had to really think about what qualities the role had that matched my own personality, and think about what I was interested in, whether that's working with people who are results driven, being eager and excited about a fast-paced environment. I think today, now knowing a lot more about investment banking, my answer would probably be a little bit different, maybe sound a little bit more sophisticated in terms of the types of clients that I like working with and the industries that I'm interested in. But you don't have to know everything.
Yeah, I'll take a quick stab at that. So as I mentioned in the intro, I was not from a technical background, so I had a history major, did some econ and some poli-sci. And what I focused on was, one, my interest in finance generally, coming from reading the Wall Street Journal, reading the New York Times, reading Bloomberg, paying attention to what's going on in markets, and then trying to explain how I have the intellectual curiosity to learn more, despite not having been a business or accounting or a finance major. I spent a bunch of time talking about my leadership experience on campus, right? So I was the president of my college, and talking about, some of the summer jobs I had. Like, you would never imagine that working at a restaurant has pretty good parallels to being a first-year analyst on a banking desk. But, having had the experience of being in a role where it's the similar fast pace, and you're responding to clients, and you're trying to keep something running and put together materials for a client, that's what banks see as valuable. So trying to piece those pieces of your background together to explain your interests is really where things play out well.
Great, thanks all. And so, Chris, I'm wondering if perhaps you could overlay, some examples of interviews you've seen where candidates were, did a really stellar job of connecting this story, versus some that maybe felt a bit more generic and less personal, and how candidates can develop their story.
Certainly, no, I appreciate it. And so I think what I usually look for when I'm interviewing are two factors. One is really around show, not tell. So going back to your high school English teacher who would always tell you you have to show instead of just telling me. And that can come in a couple of ways, but typically it is being able to talk about prior experiences and drive a thread through how that prior experience got you to be more like the things you want to see in investment banking and has less of what you didn't enjoy. And so being able to tell a story of doing more of what you like and less of what you don't, and how banking fits that better, is very compelling. Additionally, I'm always interested to find intellectual curiosity, and specifically intellectual curiosity about investment banking. And so being able to put together I was watching CNBC and I heard this interesting thing that I wanted to learn more about. And so I did this follow-up research on it, and here's what I discovered. And that gave me insight into why I'm interested in banking. Or I noticed I always read articles in Deal Book on the New York Times that have to do with, M&A for industrial companies. And so I went and, learned about this transaction. That level of intellectual curiosity directly shows that, one, you have an understanding of investment banking, and two, that you have a true interest and excitement for the job. And that's going to be extraordinarily compelling versus saying, I'm interested in this. You've shown me not only are you excited about it, but also starting to tell me about your problem solving and your analytic abilities based on that kind of follow up and how you explored and wanted to learn more about the business.
Thank you. Yeah, I would encourage you all to do that homework and do that research if you haven't already, because this is also going to be a process where you are figuring out whether this is really interesting to you. Maybe you heard banking is a great place to start your career and it's really rigorous and yada yada, but you want to make sure that you're invested in the reason that you want to be involved in this industry. And so doing that research will help you figure that out and figure out whether there's really a through line that makes sense for you. And I will also note that the reason we spend this much time on this is that I think often candidates can overestimate the weight of the technical aspect of the interview and underestimate the weight of the fit interview. So as an analyst, you will be spending a lot of time in the model or in PowerPoint and the technical aspects of the job. But at the end of the day, we are advisors and we're consulting clients and crafting stories. And our decks are just the background and the support that we have to speak to the story. And so this question is really the first impression that folks get. So I encourage you to spend specific time on this. I know as I was recruiting, part of the process I did was jotting down all the skills I felt were relevant for an analyst and saying, okay, here are the ones I'm really good at. Here are the ones I might not have as developed. Let me identify in my experience what ties to what's necessary that I'm really good at, and I'll tell that in my story. So spend the time really charting it out in the same way that you're drilling technicals on Quizlet, and practice, especially in a virtual environment. It is so easy to get tripped up when you see yourself in that reflection. So sit in front of your laptop or whatever it is and practice your interview a few times and see how it feels and how it comes across. I think that would be really beneficial. Cool. Any final comments on the story from panelists? All right. So we'll go ahead and move into valuation. I'll just get this screen shared again. So again, we'll try to take this from a more topical view, and I will emphasize that there are lots of guides out there that we can refer you to and YouTube videos and all sorts of things to dig into particular technical aspects. So I encourage you to do that as well. But we'll go ahead and cover the three main valuation techniques that you'll need to know in investment banking interviews. So the first are deal and trading comps, which are relative valuations. And so the reason we refer to them as relative is because you're looking at what this company is worth based on what its peers and its environment are worth. And so there are a few ways that we do this, but we tend to look at multiples. So multiples are saying, like, what is the value of the company, or what are people willing to pay for it? Versus as a multiple of how much they're earning. So if you hear that talk about multiples, it's really like, how do we figure out how much value this company carries over what it's earning today? To do that, we look at enterprise value as what we would pay for this company. And a very simplified way of thinking about that is taking the equity value, the market value, so the number of shares outstanding for a company, times the price per share. And then adding the debt to that, because if you buy the company, you're now going to be obligated to pay the debt to those debt holders, and then we subtract the cash because you may use that cash to pay down the debt to those debt holders. And that, in a very simplified sense, gets us to our enterprise value and what you are willing to pay to purchase the company. One of the main multiples we use is EV to EBITDA. So EBITDA is earnings before interest, taxes, depreciation, and amortization. And if you've never taken accounting, that can be like super foreign. But the point of EBITDA is to strip out all the noise and look at earnings that are comparable across companies, regardless of their capital structure. So, if you have a company that has a ton of debt, obviously they're going to have, higher interest. If you have taxes in different domiciles, like you're going to have tax differences. If you have more physical assets, you'll have higher depreciation, and then amortization refers to your intangible assets. So what EBITDA does is it says, let's look before all of that impacts your earnings and try to get to an earnings number that is comparable across companies. So then you would take that enterprise value, the value you're willing to pay for the company, and look at it as a multiple of the earnings that you have when you strip out all the noise. And then you take that multiple and compare it for your core company against, the other companies that you think are relevant to understand how it's being valued and how folks are valuing essentially its future earnings growth. Sorry, I'm having some trouble. There we go. So another multiple that we'll use in our valuation is PE. So that's price to earnings. And you'll hear this a lot when you're recruiting for banking. One way we have shown on the slide to calculate this is price per share over earnings per share. I want to also voice over that same formula could be written as market cap over net income, because your market cap, right, is your price per share times the number of shares outstanding. And then your net income is the earnings per share times the number of shares outstanding. So that could be another way that you hear people calculating PE ratios. When you get to both of these multiples, whether it's EV, EBITDA, or PE, you're going to be comparing your core company's multiple to the multiples of the comp set you've chosen. Comp is like comparable companies. And so you might select comps based on similar industry, geography, product, margins, like what's the cost of creating these goods versus what they're sold for, size, and business model. But we also want to add a bit of color that your comps may end up looking different than you expect when you're being really analytical about the way that you're selecting competitors. So an example that I gave on our last session was that I had a summer analyst who I worked with who was really great, and the company that he had to focus on for his project was Hormel. So if you're familiar with Hormel, they typically did packaged meats, like lunch meats, deli meats, things like that. But in the past few years, they've really been moving toward snack foods and things like peanut butter and such. And so in his first cut of comparable companies, my intern, summer analyst, put a lot of companies that were meat related, like Tyson. And there aren't a lot of public meat companies, as an aside. But what I talked through with him was that, because Hormel is making the shift to more packaged goods, you may want to consider companies like Kraft Heinz and Kellogg in their comp set, because they may want to be valued more like those companies than like the meat companies that you may see. Chris, I'm wondering if you maybe want to give an example from your field of how you think about comp sets.
Yeah, certainly. Thanks, Chandra. And I think some of this also goes back to what you were talking about earlier, that a lot of what we're doing in investment banking is not only the blocking and tackling of the technical analysis, but also the art of telling the story. And to that end, some of what we might be doing is trying to help tell a client's story in the most favorable light for them, particularly if we're saying advising them on a sale process. And so an example that I've seen recently in the infrastructure space, where I spend a lot of my time, was looking at comps for airports. And we were looking at an airport client, and instead of only looking at other airports, you can look at them at different geographies, different regions, was to also say, well, what other asset classes are very similar? And if you step back, airports and roads are very similar in as much as they rely on interstate travel. But airports are typically considered slightly more risky, but our client had very, very stable traffic. So could we use a comp for toll roads that would actually tell a story of a higher valuation than only the airport comps? And so thinking more expansively around the comp set in a justifiable way is actually helpful to tell a story that could be accretive to your client as well on whatever process you're advising them in.
Awesome, thanks. Let's just hop back to the slides here. So those methods that we talked about are relative valuation methods. The other valuation method that you will need to be familiar with if you're going into investment banking interviews is the discounted cash flow analysis, or DCF for short. And so taking this at a high level, the point of a DCF is that it's an intrinsic valuation. So rather than just looking at the way peers are valued and using these multiples to arrive at a valuation, you're looking at what are the cash flows that this company can generate, on its own for forever. And you want to say, okay, if I add up all of those cash flows, that's the value of the business to me. Now, the reason you're discounting is due to this concept, time value of money. And that's the idea that $1 today is worth more than $1 tomorrow. So, and that's for a variety of reasons, one of which is inflation. And, if you sit on $1 today, it's going to depreciate in value versus if you invested it and you were able to earn some interest on that dollar over time. So that's the general concept of why we are discounting these cash flows to arrive at their present value. So step one in a discounted cash flow analysis is going to be to project the cash flows for a number of discrete periods. So this could be 3 years, 5 years, 10 years. 10 years is definitely on the longer end, and you want to typically keep this shorter, so in that 3 to 5 year range. The reason for that being that as you're projecting these free cash flows, you want to make sure that your assumptions are as tight as possible. And the further out you get, if you're projecting for year 6, particularly in an environment like the one we're in today with COVID, your assumptions may not be as tight, or you may not have as much research to inform those assumptions. So you tend to see a shorter period of particular years where you'll be projecting the cash flow. So you'll project the cash flows for year 1, 2, and 3. And then discount those using a discount rate. We tend to use the weighted average cost of capital. So this is breaking it down exactly what it sounds like. It's a weighted average of your cost of capital, and the cost of capital is going to be the cost of the different forms of capital in your capital structure. So typically equity and debt. So it's a weighted average depending on how much of your capital structure is equity and debt. Cash and debt. And you'll use that rate as your discount rate to discount these cash flows. Then you will arrive at a terminal value. So you've got these first 3 years of cash flows, but you want to know what all of the cash flows are that the company will generate for forever in perpetuity. And so there are 2 general methods that we use to do this. The first is the perpetuity growth method. So in this method, you're going to assume that the company is going to grow at a certain rate until the end of time. This is going to be a pretty low rate. Typically, you're going to use something like the rate of inflation or GDP for the particular country where your company is located or incorporated. One thing to note conceptually about this method is that you're assuming that a company is going to grow forever, which is, it's a bold assumption. Companies who would be valued in this way have only really been around for a max of 100, 200 years. And so just something to note, not likely to come up in the interview, but something to think about conceptually is that is the assumption that you're making when you're using the perpetuity growth method. The other way to arrive at a terminal value would be with the multiple method. So you would come to the projected EBITDA in year end, so like say year 4, and then you would ascribe a terminal value multiple to it that you may find in equity research reports to arrive at that terminal value. Your next step would then be to discount the terminal value cash flows and then sum up that discounted value of year 1, 2, 3 and your terminal value to arrive at a net present value, which would be what you're willing to pay for the company today. I will pause there. Chris, is there any overlay you'd like to provide on the DCF?
I think just two things at a high level. One, you will find typically a lot more weight put on the DCF analysis, given that it's intrinsic to a specific company rather than comparisons. And so typically the DCF is the primary driver for valuation, and we might look at trading comps or transaction comps more so as a way to sense check the results versus as the primary valuation driver. The other thing that I would note is I think understanding the concepts around the DCF are the most critical and important piece. And so that means being comfortable with the idea of time value of money, of why we might project forward for a couple of years in detail, but recognize after 3, 5, 7 years, it'd be very common we have to make some terminal assumption versus projecting out all the way into the future. That those core concepts are going to be the most valuable piece. Investment banking is an apprenticeship business, and we'll teach you the nuts and bolts of how to put the right Excel formula in place. If you know it, that's great. But we're more interested in is do you understand the underlying concepts and why we approach valuation in this manner is going to be much more critical versus understanding exactly the steps that are taken to get there.
Thank you. And I think, misspeak earlier. I did and then corrected myself, but you'll be looking at cost of equity and cost of debt generally when you're looking at that weighted average cost of capital. For some companies and extraneous situations, you would look at, you'd add cash in as its own weight, but that's not typically something that shows up in your typical DCF analysis, and it's for companies who tend to hold a really high cash balance. Just wanted to add as a note so no one is like tripped up if they're taking their notes. I was like, something went wrong there. Yeah, and a little bit of color that I would overlay here is as you are prepping for your interviews and you're reading these guides, really try to piece together how the puzzle fits together. So for example, my sophomore year when I was interviewing, I got a question that I wasn't expecting, which was like, okay, so you've done this valuation, you've done the multiples method and the DCF, and you're putting it on a football field, which is a graphic that shows, kind of the range of values you could get with different valuation methods depending on how you sensitize. Which one is generally going to be widest? Like the widest range of valuation. And I was kind of like a deer caught in headlights because I hadn't ever thought about that. And I, made up some answer based on whatever information I had at the time. But the interviewer was great and walked me through it, and I did get the offer. So, but the answer was the DCF because it has a lot more assumptions that you can flex and sensitize. And so your range may be wider than the other methods. For example, especially if you're looking at a comp set that is pretty similar to your company, you wouldn't expect the range of PE or EBITDA to be, wildly wide. So just encourage you to ask peers and professionals who you are networking with to ask you questions that push your understanding that don't show up in the guides to make sure that you are prepared for those kinds of questions, because I candidly was not. And it's the kind of thing you won't know until you get it. But cool. So let me hop back over. Next, we will just briefly touch on industry overview, which you will likely get in your investment banking interviews. This is really to gauge your understanding of the industry you're stepping into and your curiosity about it thus far. So one question you are almost definitely going to get is, what is a deal that you've been watching in the news or that has interested you? And so when you're preparing, you'll want to have a deal, top of mind, and you'll want to have all the numbers, back pocket and know the multiple or the price that it's sold at and who was involved. but you also want to be able to overlay your view and your commentary, whether you think it was a strong deal or not, maybe whether one of the companies who acquired has been acquisitive recently, are they bolstering a certain strategy? So make sure that you are informing your answer with your view and further research past, the press release that says like, here's what happened and here's how much it cost. Also encourage you, I know M&A is super sexy typically, but encourage you to look at all of the deals that have been going on, especially now there are a lot of interesting financings. So I know there was an airline who looked at like converting their credit card funds basically to be immediate financing. So like,
mileage program.
Yes, lots of interesting stuff going on and lots of stuff to dig into. So encourage you to keep going past, the first like Lululemon bought Mirror article. And then you also want to know some macroeconomic trends, for example, where oil prices are at or where gold is at, how Brexit is affecting the market. And today, obviously, with COVID, what really low interest rates are doing, what it means that companies all went to the bond markets for financing in March and April and now have all this cash, and what are they going to do with it now? So think about those kinds of things as you're doing your reading and start to ask those questions and continue to dig in wherever is interesting to you. If you do have a specific industry preference, it's definitely helpful to voice that, and that also should have been shown throughout your networking. So as you're getting on calls with folks who say, a key piece of advice I would give is that I've done a lot of networking calls with students who are interested, and they tend to leave the call saying, if you could connect me to someone, that'd be great, because that's what they hear you're supposed to say. And I push people to see these calls as things that are informing their experience and helping them to prepare for the interview. So when you're asking that question, say, hey, like, thank you, this has been great. I am interested in learning more about X. Can you point me to someone who can tell me about it? And that X could be an industry, it could be a product, it could be, a specific employee resource group, whether you want to talk to someone with a queer identity or a certain, background, certain school background, like help point people toward how to help you. Bit of a tangent. But yeah, so that's what you'll likely need to know in terms of industry overview. So question for our panelists, in your role, how does valuation get applied day to day?
I can go ahead first and tackle this one. So we work with our clients every day on various sort of on helping them figure out what is the range of valuation. Going from a downside case where we're underwriting different types of risks and potentially a black swan event that another GFC might happen, and what can you get your money back, all the way up to what is an upside case where you're potentially growing the business and pie in the sky stuff, and helping them kind of think about that stuff, and then really formalizing in the middle what is your base case. It doesn't have to be symmetrically in the middle. It's probably I'd probably say it's closer to the downside than it is to the upside, but helping them really look at what are the value drivers, how does this business work, what is driving revenue, what is driving cost, what are some potential financing optimization or capital structure optimization that you could be doing to really drive value and increase value for your client's bid, or if we're working on the sell side mandate, potentially really helping them pushing the management team to think further about the business plan. What can they actually be? What kind of value drivers can they be, or value levers that can they be like factoring into their business plan over the next 3 to 5 years that they could talk to during management presentations and really stand by. So really pushing the client's thinking in terms of how could they add more value, getting them more comfort around the different value drivers, and really provide them with arm them with as much information as possible to either help them provide a winning bid, or really or message to the market what is the business plan and why this business plan is realistic and will kind of generate the highest potential bid from buyers. So that's, I guess, how valuation applies to my job every day.
Very quickly, from my perspective, what's interesting is, unlike most of the other people on this call, which are in either M&A groups or coverage groups, I'm in a financing group. So what we do is we help companies raise capital. So whether that's in what I do is equity and equity linked things, but whether it's equity or debt the way you have to think about it, right, is valuation is important because it determines the pricing at which you're going to go raise your capital. So are you raising your capital at a premium or a discount to the last time you raised capital? How does it relate to your earnings, past, present, and future? How does it relate to your peers? And if you think about something as simple as, or not as simple, but complex like an IPO, where you're trying to sell your shares in the market for the first time, there's a lot of things that play into it, including which peers you pick or which peers investors pick for you, right? So you'll see that there are companies that are super risky, like biotech companies, where it's really a matter of, will your drug in the future work, and how do you discount the potential that your drug may work in the future back to evaluation today? Or there's companies that are super stable and slow growing, and kind of everything in between. But those companies that it's really a matter of, well, hey, we only grow at 3% a year, but we want to compare ourselves to a software company because we know software companies get better valuations than companies that only grow 3% a year. How do we kind of tell our story as if we're a software company? And what we do in an equity capital markets group is really try and help companies craft those stories. The other point I'd add, right, is in an interview, the one thing that I would kind of piggyback off of what Chris was saying in terms of really understanding the drivers of a DCF is understanding the drivers of a valuation question, right? So someone may ask you why Tesla has so much of a higher valuation than GM or Ford. Those kinds of questions, and really being able to pick out like what the factors are that an M&A buyer or an M&A seller or an investor would think about as to why a company deserves to trade at 10 times or at 50 times. Being able to identify that is kind of the backbone of investment banking, more so than I can figure out how to put an NPV formula into Excel. And that's what they're going to care about, especially for those of you that are interviewing as sophomores or freshmen or early stage juniors, where you haven't necessarily had all the accounting and kind of deeper level finance classes.
Thank you. Any other color from panelists, or happy to tie up? Cool. So I know we have run up right on time again. I'm so sorry that we have a little bit less time for questions, students. So I know that there are a couple that we have, and I'll try to address them quickly. And then before we close out, I will just show on the screen all of our contact information again, so that you have that. Feel free to reach out to us anytime with further questions. So one question that we got is like, what is a day in the life during COVID like? The answer for me has been that it's changed month to month. So in March and April, it was really wild. It was like, there's news every day, and really most of our clients were figuring out whether they were going to go to the bond market for financing. So I had a client that did end up doing a deal, but literally every day at 8 a.m. we had a call, a go, no-go call. And it's like, okay, where's the market at today? How do we feel? And for like a week and a half, it was a no-go. So it's an interesting feeling to like be on a call with the client, figuring out, whether the pricing is going to work out that day. And when we finally launched, it was a great feeling. And then I would say that in the last, since June, mid-June, I would say, clients are turning to capital allocation. So one of the clients that I have is a large, essential retailer. And so their business has been faring fairly well during the COVID impacts. And now they have all of this cash on their balance sheet. And so the question is like, what do we do with that? Do we go out for M&A, for bolt-on acquisitions, or to buy up, geographies? Do we return cash to shareholders? Share repurchase, probably not going to look great right now, like in the limelight, not the best choice probably for folks. Or do we issue a special dividend? Do we increase our dividend? So lots of questions around what we do with all this cash now that we have it, which I don't think people expected to be, what they were asking back in March and April when they were raising those finances. In terms of my actual day, like, you have so much more time as an analyst when you're working from home. So I work out more regularly, like if I have a brief break, I'll go for a walk. I probably get to fit in more time for volunteering with things like O4U. And so that's great. And so, another question we had was, how will work-life balance be impacted in the future? And I hope that we're able to cut out a little bit of the noise and keep some aspects of this. Because I think that just being able to squeeze in that workout in this lifestyle is like super important and has been great for me. And also I would say that people have been a lot more personal in this time. So we have small group Zooms with our group, and we have happy hours, and like really talking about how the world is impacting people's personal lives. And so that's been something that I've enjoyed during this period of COVID, particularly with a lot of the events impacting us around racial equity in America. I saw lots of great conversation happening that I don't know would have happened if we were in the office. So that's a quick note I will give. I will pop our contact information up on the screen quickly. But again, thank you for joining us. Hopefully this was helpful, and feel free to reach out to any of us with specific questions at any point in time. Thanks, everyone.